Hello everyone, this is Jerry again, and I've got some figures up here on the chart and we're going to go over those. Uh, we were talking about, is cash flow necessary? For me, I think somewhere around 15% and up cash flow would make me feel pretty good, so I would be happy with about $360 a month cash flow on a property earning $2,400 a month up here. 2,400 times 15% is $360 a month. Remember our example of the home we wish to buy for $165,000 at 9% interest for 15 years would be $1,673 a month. We're hoping to buy this with no money down, and if we spend $27,000 on renovations, we hope we could get it for no money down. Good thing about that is the owner would know, well, you got some sweat equity in this property, you got $27,000 in it, so maybe he'd do it for no money down. If we rent for $2,400 a month, mortgage payment on $165,000 for 15 years is $1,673 a month, and let's say taxes is $210 a month, and insurance is $150 a month. That leaves us with a cash flow of $367 a month. So that falls within my range of cash flow. What's our return on investment? Well, to get that, we need to multiply the $367 a month times 12, be $4,404, and return on investment is $4,404 divided by, what is our investment right now? Well, our investment is $27,000 right now because we didn't pay any money down. Our return on investment would be 16.3%. Now that's pretty good. Not too bad. Remember though, we don't have any maintenance in here or repairs in here or vacancies. Also, there was no pay allotted for your time and labor. That is one reason the term sweat equity is used often in real estate investments that you own and manage. The sweat will come into play when you own the property. The equity of ownership hopefully will come later, but it's not guaranteed, as I mentioned before. Okay, let's just say the seller wanted 10% down. What would this do to my cash flow? Well, 10% down on a $165,000 property would be $16,500, so I'd leave us a balance of $148,500. And if we did 9% loan for 15 years on 148.5, it'd be 1506, that number right there. So to get our cash flow, we'd take the $2,400 a month minus the mortgage payment, 1506, minus taxes and minus the insurance, and we'd come up with $534 a month. You say, wow, that's pretty good. You came up with more money. Yeah, you did, because you had a down payment. So that increases that number right there. So we took the 534 times 12 to figure our ROI. We take 6408, which is the 534 times 12 months, 6408, and we divided this time not only our 27,000 renovations, but our $16,500 for down payment, and then we come up with an ROI of 14.7%. So what does all this mean? Well, if you pay money as a down payment, it'll increase your cash flow because the monthly mortgage payment is reduced. Return on investment will decrease slightly in this example, but not by very much. The return on your investment of the down payment renovations is what got you the 14.7% on your investment alone. That's probably 5 times what you can get on a bank CD at this period in our economic history. At least 3 times. The news just keeps getting better. Not only will you get 14% interest on your initial investment, we also got the tenant to buy the house for you with his rental payments. And there's more good news. At tax time, you get to write off all the interest you paid on the mortgage note. Your tenant made the mortgage payments, but you get to deduct the interest. You get to write off all expenses you paid on taxes, insurance, maintenance, service calls, all repair work. And after all these deductions, you still get to get another one, depreciation. Yes, I talked about that earlier. Yes, even though your property is appreciating in value, the IRS will allow you to depreciate the property and any improvements you made to the property. Why do they do this? It's the government's way of helping to keep investors interested in providing shelter to the citizens of the country. This is a business that provides one of the necessities of life, and they intend to give you a tax incentive to those who are invested in it. How much is the depreciation valued on this sort of property? Well, presently, the depreciation schedule on homes used for rental purposes with a cost basis of this property, $165,000, would be 27.5 years. Guess what? That amounts to a depreciation write-off of $6,000 per year for the next 27.5 years. Any improvements, you would get also have a depreciation amount. Some, such as furnaces or central air conditioning, may have a schedule of 5 years or less, and you can write that off too because they depreciate those. With depreciation of $6,000 per year, any profit you made through cash flow will become tax sheltered, since there will be little profit to show after depreciation and all the other write-offs you took on expenses on your property. So what's so great about not having very much money to show for this investment? Well, you own a property with some cash flow. You won't be paying much federal and state income tax by owning the property. The tenant will make the mortgage payments, property tax payments, and insurance payments by paying the rent. You will have to pay for repairs and maintenance. Of course, those will be written off on your federal and state taxes as well. When you write off a repair or maintenance on your property at tax time, it still costs you money, but not the full price. Since the highest tax bracket is currently 38% and the lowest is 0%, that means the repair or maintenance either costs you the full price if you're in the 0 bracket, or 62% of the price if you're in the higher income 38% bracket. Even after a mid-range tax bracket of 20%, you actually pay 20% less for the repair than a regular customer due to the tax treatment of the government. You may ask, why would I buy a property where the cash flow is solely based on tax write-offs? No, I would not. Let me explain that. In other words, if you found a property that has 0 cash flow, but when you apply the tax savings to my own personal tax situation, I now have a positive tax flow. Well, your personal tax situation can change in 1 year, which would cause you to be in a negative cash situation with that property. The federal government changes tax laws periodically, and your own personal tax liability can change from year to year. I would simply judge a property for cash flow without any tax-related savings. If you don't feel comfortable with the cash flow at that point, don't try to make things better by using tax savings you might receive in future years. I'm sure there are exceptions to this rule, especially if you're in one of the higher tax brackets. I just don't do it, and I don't recommend it. Anyway, there was a lot of information in this session, so hope you got everything off my board, and take that and study it and make your decisions based on owning single family homes. Bye.